Friends, whenever we talk about the stock market, the biggest fear in our mind is what if there is a loss? Is there any strategy, any concept that can prevent our loss, but also make our money grow with the market? Well, my mind was blown understanding such a strategy which will make your money grow year on year and also protect your wealth. If a crash occurs in the market, even at that time, you will not panic in the market. Instead of decreasing, your money will double and grow rapidly. How? To explain this concept, a SEBI registered expert is joining me today, connected with us, and he will share insights from his journey of over 30 years on how you can invest in the stock market the right way and consistently make money. So, connected with me is the CEO of FinIdeas, the one and only Mr. Govind Jawar. Govind ji, welcome to our Go Self-Made show.
Thank you. Thanks a lot.
Sir came from Surat for us. I felt very good. We connected 3 years ago.
Right.
And 3 years ago, when they connected, their concept was the same and the concept is still the same today. So now I have also tried and tested this concept for 3 years and I felt that this is some worthwhile information that you should have and you are really going to enjoy it. Listen very carefully. Everyone invests in the stock market, but the way Govind Bhai does it, this is a class apart. So your investment strategy, the whole concept, our audience would like to understand today how you actually make money from the stock market.
Great.
And how are you making money for your clients?
Fair enough, Anna. Thank you for inviting me over here, Pushkar Bhai. Truly seeing your setup makes me feel very amazed. And what we do, let me first make some corrections that we became chartered accountants in 2001 and have been working on this journey for about 24 years.
Okay.
And we are SEBI registered investment advisors. So a disclaimer at the beginning, investment in securities market is subject to market risk. Read all the related documents carefully before investing. What do we do? So our main concept, Pushkar Bhai, is whether growth with safety is possible in the market. So we understood that it does. What needs to be done for that? So our first logic is that we invest money in the index. When we invest in the index, it sometimes sounds strange, like what's the smart thing about it? But then it becomes clear that the index itself is a smart thing. The way it is developed is that it is an average of the top 50 stocks. Weak stocks automatically exit. Strong companies automatically come in. So first, I get the confidence that if my money is invested in the index, it won't go to zero. And second, if I keep it there, sooner or later, due to market cap and valuations, it eventually increases. What do we do along with that? We add protection to it. It sounds like, is there protection in the market? So the put option is protection. Derivative markets were indeed created for hedging. So we purchase a put option. It seems like we are paying the premium for the put, but in reality, the premium gives us the assurance that sooner or later, I will recover my cost.
Yes, absolutely.
And along with taking a put, we also get the assurance that whenever the market falls, the put gives us back the difference equal to the market drop. So we remain protected on the downside. Our maximum risk is only the premium paid, and then we use some more strategies. We do interest arbitrage by creating positions through futures at lower interest rates and investing in debt at higher interest rates to earn interest. We increase our efficiency with those differences. I will explain this in detail to you shortly, what we do. So what is this combination doing overall? This combination overall is doing this. If the market rises, we will rise, and if the market falls, our downside risk will remain limited and then nothing.
So this is how we are doing.
So, what you explained briefly, people might actually not have understood it yet.
Yes.
So, we will take each example and explain each point with clarity. Just give us time because this concept of investing, you are going to invest your entire life savings. So take a little time to fully understand this concept, because today where you think you will make money from mutual funds or SIPs, this concept can actually make you a lot of money. So let's understand this concept with an example.
Alright, Saintaya Pumpkie. So let's understand this with a complete example. We will understand this whole concept in 3 parts. What is called a good asset class, how safety is connected, and how that safety works. And finally, So we understand this in three parts. Absolutely. So first, as I mentioned, we choose the index, and the main reason for choosing the index is that it is the average of India's top 50 stocks. Today, at the top are HDFC Bank, Reliance, and TCS. Some time ago, Satyam Computer was also among these top 50 stocks. Reliance Capital was also there, but what happened? As soon as the value of those stocks fell and they came to number 51, they automatically went out and other stocks came in. Besides saying, mom, also, if it is always the average of India's top 50 stocks, so it means it has given us the confidence that it will not be zero. We often quote this example that 2 years from now, your seventh generation will come to Earth, and if the index you bought goes to them, do you know what they will have? The top 50 companies of that time. The top 50 companies of that time, it's not a matter at all. It means when their photo is on our wall, our future generation will say, grandfather was so smart, they chose a product that is always evergreen, it will always remain at the top. So today, maybe that company hasn't even come to the market, which will be at the top at their time. And they have purchased it based on their concept. Such a philosophy that you will always stay on top. So, as our elders say at home, always stay in good company. The index is actually this, a product that stays in good company, right? So in this way, we first chose the index, and along with it, the index gave us a variety linked with market valuation. So as you understood, sooner or later, the new companies that enter the index or become top have their market valuation grow larger. When the market cap increases, the total market cap of 50 stocks increases, and when that increases, the index rises. So in the long run, the growth of the index should match the GDP plus inflation, and we are getting that. I have a small question. Please go ahead.
Now I understand we chose the index, we chose Nifty 50, right? Now for growth, some people also invest in mid cap, right? Now the mid cap we have is mid cap Nifty. Yes. That is also available to us as an index, okay? And I can also buy its ETF. You can buy it, so I can buy that too, okay? Up to here. So
Right. Okay.
And when it comes to safety, we will come to put options for safety. Why are we doing it? Let me tell you honestly, 3 years ago, when they mentioned it, I heard it, but I literally understood it within a 3-year duration. I had heard what they were saying. Then I thought, why are they taking a put option? It's an example, right? That there has been a rally in the market for the past 3 years, as you have also seen. But now I have more questions, and those questions are not mine. They are your own questions. So my question is, you said you agreed on Nifty. You said put option. I said, okay. I say, if I allocate 50% of the fund in Nifty and take whatever put we have, and with the remaining 50%, if I take a long-term put option in mid-cap, how will that be? It's not available.
Put option of mid cap. It's illiquid. Yes. So that's why our work didn't happen, because it's illiquid. Yes. So if liquidity comes tomorrow, then long-term options for the mid cap index are not available. 5-year options for the Nifty index are available. However, the liquidity that remains is normally in the December month options of the year. So liquidity is available in December 2025 and December 2026. There are none for mid-cap. So for us, that will be out of syllabus, then 1 month, 2 months, 3 months.
You will go only as far as it is available. And even then, how much will the cost increase?
Okay, so like it's IV. Normally when the index is IV runs at 14 to 15%, it is expensive at 20 to 21% IV. So the IV runs expensive. So how much money will we get here in options? 3 to 3.5%. Even within options, about 5% of our year will go 5. 5 will go. We have to consider a cost of 4 to 5. Right now it is 4, but on average, we have been doing this since 2014. So our average experience is to consider a cost of 5% per year. Okay, so I also accept this cost. This cost is okay. If we take a mid-cap monthly option, how much will this cost increase? The behavior of monthly options is altogether different. Then look, the whole game here is about theta. So what is theta doing and why are we buying this option? Our purpose for buying options is insurance. Yes, I understand that too. So it means my purpose is not to earn from trading it. Who is settangi or toki? No, absolutely not. And what I would want now is that I am getting two insurances. One insurance says I will charge you 100 rupees per day and the other insurance says I will charge 10 rupees. No, look, if there is such a big difference, then okay, then the 10 rupees one. What do we do instead? We approach maturity. Yes, we cut it and take it for the next year. 13 or 14 months earlier, because for us, 13 or 14 months earlier means I took this December's one this time.
Only 6 months now.
Took December 2025. Yes, okay, 6 months. Almost in October or November.
After 3 months.
Yes, I will square it off. All right. There must be a premium of 2 to 2.5% on the current one. I got that back.
Yes, correct.
Yes. And if I take for the next year, then for the next year. Instead of 12, I got 14 months. Yes, I got December 2000 in October.
Absolutely. You got to go on for 40 months.
Uska sa tawad the VSI, the additional premium didn't seem significant. That up, and what did we need to see? Like our purpose was that I have purchased an asset and I need to take protection with it. To stay protected, I deal where I find a lower premium.
But I asked a small question because if mid-cap options are available tomorrow, then returns can be higher in mid-caps. So can this same strategy work there?
Can it? Yes, it can work. The strategy I'm about to discuss with you, we track this same strategy in the US, on Nasdaq, in Australia, on ASX 200, and in Japan. It works the same way everywhere.
Doing the right work. Yes. So it can be run in the multinational way. Exactly. International.
Yes, you can do it. So now let's understand further. So far, you have understood that we chose an asset class index, found an asset class like an index with a strong base. I know it won't go below that. Now, what happens with it? If I purchase the index, if the market rises, I will gain. But if the market falls, I don't want to incur a loss. So you don't want to incur a loss. In this line, we are with limited risk. We cannot do it with zero risk. So what did we do? We purchased protection along with the index. So for example, let's say Pushkar Bhai, I am giving an example that whatever the index is, it is running at 10,000. So you bought the index at 10,000. What this means is that if the market goes up, you will earn. If the market goes down, you will incur a loss.
You will do it. To avoid loss, what did you take? You took protection along with it.
Looking at the past 10 to 15 years experience, the annual put option in the index comes around 5% a year. So if there is a 5% premium, then for you, a 10,000 index with a premium of 500 rupees makes your overall cost 10,500. Absolutely. So where a normal investor was getting the index for 10,000, our cost for the index was 10,500. But we got a security with it. The security is that if for any reason the market crashes, no matter how much the market falls, my 10,000 will remain fully protected. My maximum risk was the premium I paid, 500 rupees. It's just that 500 rupees. This means suppose I created a portfolio worth 1 crore rupees. I'm giving an example of 1 crore here. Does it mean to do less than a crore? If someone created a portfolio worth 1 crore rupees, they know that at any time during the whole year, whether it's morning, evening, day, night, whether the market is open or closed, whatever happens.
It cannot go below 95.
Very nice. It cannot go below 95. Now, this is a good point. The biggest pain of the stock market is this. Everyone knows that you get good growth in the stock market.
But if it goes up, then
Yes, if the market crashes in between, the money breaks. That is a very big pain. The solution to that pain is that in the market, we are sleeping peacefully with limited risk. But if there is a benefit to anything, there is also a side effect. So what is the side effect of this? The side effect is that if tomorrow, the entire year, the index remains at 10,000, the market stays the same. The year passes by.
5% cost will be incurred.
5% cost will go. If it takes 1 year, that's fine. But if the market stays the same for 3 or 4 years, then a person will get tired. So now let's understand its worst case scenario. If we first understand the bad scenario of something, then it will be easier to understand the strategy later. So the worst case scenario could be that suppose the market is currently at 10,000. 4 years passed, but the index remained at 10. So if for 4 years, Pushkar Bhai, the index stays at 10, then every year you will incur a cost of 5%. So you would see a loss of 20%. Or at suppose you created the portfolio worth 1 crore in the path. In between, the index once went from 10 to 12. In 1 year, in 2019, the index actually went from 10 to 12. And what happened in 2020? During the corona time, it went below 8,000. Again, in 2021, it recovered. Suppose it broke again. You created a portfolio of 10 million. So your 500,000 rupees for protection also got added. Absolutely right. Now, the next year, the market went from 10 to 12. Absolutely right. So the market went from 10 to 12, meaning the market increased by 20%. So our portfolio will also be 12 million from 10 million. The portfolio became 12 million. Absolutely. But our profit will only be 1.5 million because our 500,000 rupees are tied up in the premium. But the interesting point is that now in the next year, 1 crore
Okay. Next year, index 12 reached 8,000. Index 12 reached 8, meaning the index fell by 1/3. So your portfolio, which was 1 crore 20 lakh, will become 80 lakh.
It will definitely be done.
But the 40 lakh rupees of your value broke.
She will come here in the put option.
She will return to you here. So these 4 million rupees will be returned from the put. Sometimes people question whether the put gives the full amount. The difference from how much the market fell is fully received. The 500,000 rupees you paid for the premium or 600,000 paid here is gone.
He just went there.
The theta went, so 40 lakh were returned. Now the question arises, what will we do with those 4 million rupees?
Before that, I have a question. You will buy an ETF for 4 million. My question is, when will you book it? The put option has gone down now. How do we know that this is the market bottom that I should book here and it won't go down further?
Very nice. That's a very good question. But this is an advanced question. We'll take it up later.
Okay.
What will we do in the meantime? For now, let's assume we did nothing. So at the end of the year, if the index hits 12s,
So, it's okay.
so you will definitely get those 40 lakh back.
Should.
Isn't it?
Whether you book or not, they are going to come back to you.
If the option expires in the money, then you will get the in the money amount.
We will get it. So we have received that.
So we got back 40. What will we do with that 40 we got? We will reinvest that 40 at 8,000. Friends, this is the level when someone doesn't have money in their pocket.
But the person has money in their pocket who has taken protection.
So due to protection, our number of units increased. This is the beauty of the strategy. The market fell, you received the claim, and with that claim, you bought back the number of units. So your portfolio of 80 was already there, and a new portfolio of 40 was purchased.
But that average came below it.
Absolutely. Do you know what this means? Suppose this hall is worth 10 million. For example, it's set in a Abapabi. If tomorrow its value becomes 5 million, it means the hall next door is also ours.
Now there are two.
Now there are two. Now when its value returns to 1 crore, then we have 2 crores.
Absolutely true.
So what is the point? You got two benefits from protection. The first benefit is that you can be relaxed on the downside, knowing that your money won't lose beyond a certain level. And the second benefit is that if the market crashes, your number of units will increase. So Pushkar by our portfolio of 1.2 crore remained 1.2 crore.
That's what they're
But the number of units has increased by 1.5 times.
They have increased. Absolutely true.
Again, you pay the premium. The next year, the index recovered. Nothing major happened. The index of 12, which had come to 8, returned to 12. But the index going from 8 to 12 means the index has gone up by 50%. The index increased by 50%.
Your portfolio also 50%.
Your portfolio will also grow, so your portfolio 1.2 became 1.8 crore. What a part.
Absolutely correct.
So what happened? In 2 years, the index remained at 12, but your portfolio went from 1.2 crore to 1.8 crore because of the simple reason that the market had crashed in between. The market crashed, but you did not. Your number of units increased. You got this opportunity.
You didn't run away in fear. You didn't sell.
Did not sell.
Bought in reverse.
Both the opposite. You know what's an interesting point? This point often comes up, and I even question myself that investors have been standing for so many years, or we ourselves have been standing. So in the stock market, we know the line well that patience makes money, yet we are not patient. We become impatient in the market, but we have seen that if you have protection in place, you can maintain patience comfortably. A person becomes impatient. Every day when he sees his portfolio declining, he feels, what business have I gotten into? Every day I am decreasing my value. So when his value is declining daily, he gets anxious and exits in between out of fear. But if he has taken protection beforehand, he always feels that no matter how much the market crashes, he is not crashing. So he stands calmly. When he gets an opportunity at the lower level, he encashes it, increases the quantity, and thus sustains in the long run. And in the long run, wealth is automatically created. It's not like you used some great intelligence or anything, worked in the index, provided protection alongside, but this protection works on its own.
Absolutely correct.
The portfolio became 1.8 crore. Again, you paid the premium, then the market fell, but now we understand that if the market falls, we are not going to break. Rather, our number of units is going to increase. A collector means when we work with derivatives. Yes, when we work with derivatives, we need a margin there. We can provide this margin in the form of a check or stocks. According to SEBI's recent update, we can PCT में ज़ंदा है. ये 30 है, we can provide 50% in stocks. We have to give 50% cash margin. So when we keep our stocks on margin, it becomes collateral. So we kept this 30 rupees as collateral, and on this margin, we took 70 rupees of futures of the index. So overall, what happened? The client only used 30 rupees. But with 30, he got a portfolio of 100.
okay, this is not the first time we have done this or something new. You must have done this many times in your life. Whenever you have bought property, normally it is bought like this. We buy property worth 100. We pay 30 rupees from our account. We take a bank loan of 70. The property worth 100 becomes ours. If there is a profit, it is on the entire property worth 100. If there is a loss, it is also on the property worth 100. If we don't want to incur a loss, we immediately take protection with it. So this protection cost 5 rupees, Pushkar bhai, but these 5 rupees gave you the assurance that your 30 rupees ETF purchase is protected and the 70 rupees futures purchase is also protected.
Absolutely right.
You only incurred the cost of this premium. We will incur one more cost. It will incur a financing cost. It sounds strange that we are investors. What financing cost for us? We incur the financing cost here because we only bought an ETF worth 30 rupees. We created a portfolio of 100 because we took futures worth 70.
Pay the premium for the future.
Yes, when we forward the future, we have to pay the forwarding premium for the future. There's a still there.
You must be doing rollovers month on month. You would take monthly futures.
So we take monthly as well, quarter.
We also take
It depends on where the forwarding cost is lower. All right. Where the forwarding cost is lower, we forward the future there. So I forward the future. So for the whole year, our expense comes to around 5%. Now this became the biggest opportunity for us.
That two people have money.
In India, this is the only business we see where a retail investor like you and me is getting money on loan at 5%. I am not teaching how to take a loan here because we took the full 100 rupees from the client and kept it in 70 debt. But we took futures because futures are available at 5%.
And 5% of that will be deducted, right? It'll give 6 to 7% after the date.
Exactly. So we did interest arbitrage because we are getting money at 5% here. And if we keep our money in debt, we are getting 7.5 to 8% there. The interest rate of the RBI bond is currently 8.05%. So with the RBI bond, we are getting 2 to 2.5%.
We were just discussing Bharat bond. How much is it?
It's around 7.5%. Very good. Exactly. Better than an FD, and completely liquid.
You can also pledge it. Where's the pledge coming from itself?
yes, you can pledge it.
Pledge it and do arbitrage. Make a serial strategy. Even if it doesn't give 0.5%, that extra will come to 6% a year.
Yes, if a person can use such wisdom, they can do that. And on top of that, what happened? It's exchange traded again. So when you purchase on the screen, it is purchased immediately. It goes into your demat account. If you ever want to sell, you can sell immediately. It is fully liquid and there are a number of benefits.
Which RBI bond are you talking about?
RBI bond, the normal bond, RBI bond.
In the demat.
It will not be available in the demat account. It has a lock-in period of 7 years.
Yeah, that's why I was asking that Bharat bond is good. There's no lock-in, no hassle. Take your money back whenever you need it.
Yes, so the client can choose each point as they want.
It's up to the client.
So what happened here? You got to the point where we forward the futures and it cost us 5% per year. 70 rupees at 5% cost means it cost us 3.50. So what was our overall gross cost? The gross cost became 8.50, and with this 8.50 cost, we got two big benefits. First, our entire portfolio is protected, the entire 100 rupees.
But from infra again, I would say 7 to 7.5 is coming back.
He will count ahead.
It's not coming on the full amount. It's coming on 70. So effectively it becomes 6%, so there will be a cost of 2.5%.
Yes. The got incurred for 8 infra per year, and what benefit did we get? That we are fully protected, and secondly, we got the benefit of financing. Your portfolio of 100 was made in 30 rupees. Absolutely correct. 70 rupees are free for you. You invested those 70 rupees in bonds. You received 7.35, 7.5%, so you got 5 rupees back for the year. Out of 70 at 8.5 cost, I got 5 rupees back. So what was my net cost? My net cost remained only 3.50. That's absolutely correct. This means that no matter how much the market falls, our 100 rupees will not go below 96.
Can't go, that's absolutely fine.
And if the market rises, our entire 100 rupees will increase.
Friends, it might be that you don't understand this concept in one go. The video is available for free. Watch it 10 times. The things being told to you, you will find them in very few places on the internet. Managing your risk in this way and growing your money. People spend their whole lives learning this. People get caught up with bank managers, make investments, and pay 5% cost there. Honestly speaking, if you want to invest in a fund, you can do it through a CB registered advisor. Govind Bhai is a SEBI registered RE. His company is working on the same model. So if you need consultation, you will find a link in the description and pinned comment. Please fill it up. Sir's team will guide you on how to make smart investments. Let's move forward. But as I said, if you don't understand it in one go, the video is available for free. Watch it 10 times.
Thank you. The name of the strategy is, we call this plan the relax plan. Why do we call it that, Pushkar Bhai? Because after understanding this plan, we ourselves feel relaxed that an investor needed something like this. Yes, that's...
This loss should also happen.
Yes, so we are not saying that we remain at zero risk, we remain at 3 to 4% risk. We stay at calculated risk, and what happens along with that? If the market rises, we generate equity returns. Now an extension of this has been made. That extension is the basic plan.
Okay.
Now, what do we do in the basic? So you have the same 100 rupees, the same 30 rupees, created a portfolio of 100 on that same 30, the same 8 infra cost. You got protection on it, got financing. So all of this became relaxed. What's new in this? So what's new in this? Earn more yield on it. If you get more interest in earning, then your cost will automatically decrease. Yes or no?
Yes.
What happens is that sometimes there is a situation where the investor has a loan. He is paying 10% interest on the loan, and here he has invested his money in this debt, earning 7.5%. So he is making a net loss of 2.5%. Instead, he created a portfolio of 100 with 30 rupees. By utilizing 70 rupees elsewhere, who saved 10% interest there. So ultimately, if you count his overall family wealth increased. So what did the investor get in the basic plan? In the basic plan, the investor got the independence to use the remaining 70 rupees elsewhere if they wish.
Absolutely right.
But this was the second basic point.
Brother, it's fine. You can create a portfolio of 100 even by investing 30 rupees.
You can make it. Now the last point is the power booster plan. What do we do in this? So the name itself suggests power booster. If the investor has stocks, mutual funds already, so can he use the existing portfolio as well? So he can also use the power of the existing portfolio. There is no need to sell it. There is no need to sell it. So what then happens is the investor's question arises, sir, you made us invest 30 rupees. You bought an ETF for 30 rupees and you kept this ETF as collateral for the margin. So I already have a lot of stocks to keep for the margin. Mutual funds are there. Can I use my current portfolio? Again, the answer is yes. If you have your current portfolio, you can use it to create a new portfolio. So what you did was you gave your portfolio worth 30 rupees, and through futures, you created a portfolio worth the entire 100. So the portfolio became worth the entire 100. If there is a profit, it will be on the 100, and if there is a loss, it will be on the 100. To avoid a loss, you pay the protection premium of 5 rupees. As soon as you pay the premium, you get the assurance that your entire portfolio of 100 rupees is protected on the downside. So dinar pe CPS petia. The other cost of financing, Pushkar Bhai, this time that cost will apply to the entire 100. Because this time you haven't even put in your 30 rupees. In the previous plan, you invested your 30, bought ETFs, so you needed 70 in futures to make a portfolio of 100. This time you haven't put in any money, you have only given stocks, so you bought the entire 100 in futures. So 5% will be applied on 100, meaning 5 rupees on 100. So your gross cost of 8.5 has become 10. But what was the interesting point? Just this 10 rupees was your investment, and the rest of your 30 rupees stock was reduced.
And you will get a full profit of 100 rupees.
Yes. So your 90 rupees are free. You had those rupees and you wanted to invest 100, but you had additional stock. So by using them, your entire portfolio of 100 was made with 10 rupees. 90 rupees are free for you. You put it in debt. Even if you get a yield of 7 or 7.5, you got a yield of 6.50 back. 90 multiplied by that's Santinity asset.
Absolutely.
7%. So now what is your overall net cost? It remains at 3.50. Do you know what's interesting? All 3 plans have limited risk on the downside. In all 3 plans, a portfolio of 100 rupees is created on the upside. The entire portfolio of 100 grows. The difference in all 3 plans is just that the person got different payment options. The first plan was relax, in which he put the entire 100 rupees in the trading account. From that, he bought 30 in equity and 70 in debt. In the second plan, he said he would manage 70 rupees elsewhere himself. So he put 30 rupees into trading and created a portfolio of 100. And in the third plan, he said he already had several stocks. So he put those stocks on margin. He only put in 10 rupees and created a portfolio of 100. He used 90 elsewhere. So all three plans are earning on the upside at 100. The question arises, what would have been the result for those who did this work in the past? Let's see that. So here in the first column, we can see from 2002 to 2024. Since long-term options and options have come into the market, you have kept all this data.
Okay.
So here in the second column, index.
How did it progress? Its journey from 1100 to 20,000.
In the third column, it is explained, suppose someone invested 100 rupees.
So his 100 rupees increased to 33. The index grew by 71% in the year. Pushkar Bhai, you grew by 60 to 80 because your cost is 3 to 3.5%. Next year, the index grew by 11, so you grew by 7. But the year the index fell by 50%, you only fell by 3. Why? Because you were protected. Oh, see, you only 3 fell, so I say. It's a small benefit. The big benefit is that because of this, your number of units increased. They increased, right? Remember that example? So the 1.2 crore became 80 lakh, so you got 40 lakh new units. Okay, because of that. What an interesting point that is. See, when the market was 6200, your portfolio was 495. When the market came down to 2900, your portfolio did not go below 480 because you are protected, right? And Rajar, the number of units increased. So the next year when the market recovered, now 50 to 200 came. Now 60 to 200 hasn't even come yet. You reached 800. Then the market crashed again after 2 years. You did not crash. Then it recovered. You made a new high. Then it crashed. You did not crash.
Recovered. Made a new high. That's it.
So the point is that if you follow this discipline of not making big losses, profits will happen on their own. There's no need to chase after profits. Warren Buffett says there are only 2 rules of investment. Rule number 1, never lose money. At 96 years of age, he has made billions of dollars in the stock market and is summarizing his investment learning in such simple 2 lines. Never lose money in the stock market, and rule number 2, never forget rule number 1. Jeb. Focusing back on rule number 1, they are imparting great wisdom to us. They want to repeatedly make us understand that this is our responsibility to protect our wealth, right? If we can protect it, we will grow it. So the point is how to protect it. So we will understand that, brother, take protection with you and you will be protected automatically. So combining these 3 things, an index was purchased. It took protection along with it and did interest arbitrage. What was done in interest arbitrage is that we are getting futures at a low interest and investing our money in debt at a higher interest, earning the difference in between. Many times, a real incident comes to mind regarding this question. India's richest company has become HDFC Bank, while Reliance and other companies do such large-scale manufacturing and run so many processes to become a company of a certain level. What is the bank doing?
Giving money on interest.
Am I giving money on interest? Taking money on interest. That's the only difference. Takes at a lower interest.
Interest arbitrage.
It invests at a higher interest. And because of that, it became India's richest company. Right. So for us, it's a new hint that if we learn to play with interest, we can make money multifold. You know what's an interesting point here? You've invested your money at interest and you've also borrowed at interest, but every transaction is with you. Your money is aligned with you only, right? So the future you've taken is in your account. The money put in the date is in your demat. So your money is with you. All rights are with you. You can enter whenever you want and you can exit whenever you want. You can work with full control.
You haven't given your money to anyone.
You haven't given it to anyone. It reduced so smartly.
If someone wants to earn interest, they have to transfer money to someone's bank. Here you just buy a bond and the interest starts coming.
And another interesting point is that the bond is completely liquid. So tomorrow, if you need to in between.
If you ever need money, give it immediately.
Yes, and sometimes in between, an opportunity appears where I can get 1.5%, 2%.
So it's an opportunity, right?
Exactly, so you can encase it.
I mean, bonds also become cheaper and then you can buy them.
Yes.
So I have seen this. Govind Bhai understood this. I have bought the put option you mentioned. Now, if I have bought it for the end of the year, that's a long way off. Sometimes the market falls for 3 months and then recovers, right? My question was, when will we book the put option, or will we not do it in the middle of the year?
Very good. So now let's come back to this question of whether we will book the put option or not. First, the table I showed you here, if you do nothing the whole year, it still generates this much return.
Just take the yearly put option and leave it.
Or by giving the yearly put option and leaving it at the end of the year, if the market has fallen, money will automatically come from the put.
Here, Sandart and Assad, I increase the quantity as much as the money from the put, and if the market has grown, then the money from the put will not come, so you earn 3 to 4% less return from the market. Even if you do that, in the long run, you outperform the index. Perfect. So the first point to keep in mind is that you are reducing by buying insurance here. Your objective should be the long run. Perfect. Okay. So now the question arises again, can we do something in between? So yes, we do this additionally if the market is falling. So the put option we have bought above. Suppose the index is currently at 25,000. We have taken a put at 25,000. If the index falls to 22,000, we will be making a profit on that put option, and there will be a loss on the equity we purchased and the futures we have taken. So we would like to encash our profit from the put. For that, we have also created an algorithm. The point worth understanding about what the algorithm is doing is how much your cost is and what the benefit is in comparison. It keeps tracking that ratio. By doing these tech, sometimes you get the put shift from a lower level to a higher one, and you buy the lower put again. So you send the higher put and buy the lower put. The profit in between is cashed.
The profit in between was cashed, and with that, you bought new units.
You know what's amazing about this? If we do this, my curiosity is all about this. Its return will increase a lot. Negative means it won't come. Why? If the example is the 2008 crash, the COVID crash, anything, I applied any subjective approach and the put option I had bought. Now the market corrects by 20% and a 20% good fall.
And if I see there that the lower option is also decent, whenever it is decent and above, I am getting the intrinsic value completely. If I am getting it, then I shifted it that day. Let's assume the market fell 20% and increased by 5%. When it increased by 5%, it can decrease even on the rise. It means nothing, just a subjective approach. So when it increased, although my intrinsic value definitely decreased, but I captured it. There, I booked the profit of 5 lakh, 10 lakh, 20 lakh that was coming and bought the lower option for 5 lakh. Right. Now what will happen?
Now this 500,000 also became zero.
So right now it doesn't matter to you?
For us, exactly. Every year the market falls a little. If that put option we have bought, if we create a system to book it, then it will earn money every year.
There are 2 points in this.
It doesn't matter if it doesn't give. If it doesn't give for 1 year or 2 years, it will give in the 3rd year.
Right. But there is no zero risk in this. Yes, it's something to understand. Look, you initially invested 100 rupees. Yes, and you have already spent 5 rupees to protect the 100 rupees, right? If the market falls by 20 rupees, then this put gives you back 20 rupees. 5 were already spent earlier, absolutely. And now you will buy a new put above the 80 rupee level. You would have paid another 3 rupees for it. So if the market stays at 80 tomorrow, if it goes down, then your 5 rupee cost becomes an 8 rupee cost. Do you understand what I'm saying? So you increase the cost a bit because of this.
If it doesn't go up, then loss.
If it didn't go up,
And if it fell, then took an increased premium of 1 or 2%.
The additional premium you paid increased your cost to provide extra protection, but the point is logical, so here is a very good smart way. At what level to shift, brother? At that time, keep the cost rational in front of the benefit. Normally what happens is that whenever the market moves, the premiums of puts can be anything.
Anything can happen. Yes, it can be crazy. Anything can happen.
So now just apply this simple logic and leave it. We might get more profit in the put. Yes, the market might. We thought the put would give only as much as the points dropped. The put can give more. During the corona period, it happened that the put didn't just give extra money because the volume would increase.
But the point to understand here is that the new put you are buying is very good if you book it, and you will have to buy the put because our strategy is that you should never remain unprotected.
Don't stay without a put. The market can fall by 90%. You are exiting at 30%. What if the market falls further?
Exactly. So now the point comes to how much to buy that put for. The rationale is to make a ratio of the cost compared to the benefit you are getting. We have almost understood it like this. In simple terms, let me explain. We have made it 10.1. Assume 10.1 means if you are getting a benefit of 10 rupees and the cost is 1 rupee, then we shift it.
Extra expense.
Extra cost. So suppose the index was 25, it came to 22, then I want to encash the 25 put. So they are giving me 3,000 points back. So if I am getting a 22,000 put for an additional cost of 300 rupees, then it will shift. Otherwise, it will wait. Now by doing this, you remain rational. A few times it will happen that the market falls and your shifting won't occur. But you have to be happy with that, thinking, alright, no problem, the cost didn't increase. And if it comes in at 10-1, you will encash it. For those who have encashed in this way in the past, their yield increased by 2% CAGR.
That's what I'm saying. It can increase by 2% because the put will cover its cost and give it to you.
But for that, you need to be rational.
You'll have to wait more. Yes, brother, it will break the premium every day. It will give one day. The day your portfolio is negative, that day it will stand in profit.
Yes, cute. So you have to keep this logic in mind that you are following 2 or 3 fundamental rules. First, the index you have bought will always remain long. Second, you have bought protection.
It will always provide you with downside protection.
Look, those who do it with understanding will do very well. I'm honestly saying, even if you don't understand, watch the video 10 times. Another thing, some people say, brother, I don't understand it that much.
But the concept seems good. Yeah, contact their team. Your team will guide you. Yes, like what is the risk profiling of the other person? How much can they invest? How much risk can they take? In how much time do they need the money? How much return do they need? For which goal do they need it? Is there a wedding at home? Is there planning for a child?
I want to invest for 20 years. I want to invest for 2 years.
Look at all that. You may have questions. At the moment, I cannot answer them. But their team, which is a SEBI registered company, can guide you. Again, you will find the link to their company in the description in the comments. You can go there and provide your details and their team will guide you.
Perfect. It means if anyone needs us anywhere, then we are completely fine with this.
100%, brother. So Govind bhai, you gave your time to our viewers. We really appreciated it. Actually, this concept of investing, and by investing, first of all, people these days are confused. Should they keep money in debt or in equity?
In a way, you have shown a path to be 100% in equity and still stay in debt. And you also said to keep it protected below and earn money above, meaning it might take a common person some time to understand this, but as soon as they do, they'll say, wow, this is amazing. There's unlimited earning potential on the upside, downside is protected, and the market will fall at some point. So the insurance is definitely worth it, and the future you have taken on the upside is also an amazing thing. In short, I'm saying that you can create synthetic futures with it. If STD costs decrease, then this is a cost-efficient model. I really liked it. Personally, if you have any questions, do ask in the comments. Do you think money can be made from long-term investing or not? You can say yes or no in the comments. If you think money can be made from long-term investing, so write yes in the comments. The link to Sir's company is in the description and comments, and you can get in touch with Sir through that. Please subscribe to the channel, click on the bell icon so you don't miss any upcoming videos. If you have any questions for Sir, you can also ask them in the comments. Next time we will do Beska Som des Habazende. We will do a similar podcast again. We will ask questions to Sir and share his experiences with you and try to answer those questions. Do share this video with everyone who wants to invest in the stock market and keep the risk very low, because such content is rarely available on the internet. So see you in the next video. Until then, go self-made and Jai Hind.
Reliance Capital was also there. But what happened was, as soon as the value of those stocks broke and they came to number 51, they automatically went out and other stocks came in. That then, it is always the average of India's top 50 stocks. It means it has given us the confidence that it will not be zero. We often quote this example that 2 years from now, your 7th generation will come to Earth, and if the index you bought goes to them, do you know what they will have?
Top 50 companies at that time.
Top 50 companies at that time.
Absolutely right.
It means when the photo is on our wall, our future generation will look at it and say, their grandfather was so smart. He chose a product that is always evergreen. ताकि and bin the best.
It will always remain evergreen top.
It will always remain at the top. So today, maybe the company hasn't come to the market yet, which will be at the top at that time. And we have already purchased the concept for them. We have given them a philosophy to always stay on top. So as our elders say at home, always stay in the company of good people. The index is actually a product that stays in the company of good people. So, in this way, we first chose the index, and along with it, the index gave us an assurance that it was linked with market valuation. So, as you understood, sooner or later, the new companies that enter the index or become top, their market valuation increases, the market cap increases, so the market cap of the total 50 stocks increases, and when that increases, the index rises. In the long run, the growth of the index that should match GDP plus inflation is what we are getting.
I have a small question.
Please speak.
Now, I understand this. We chose the index. We chose Nifty 50. Right. Now for growth, some people also invest in mid cap. Right. Now the mid cap we have mid cap Nifty. Yes. That is also available to us as an under index. Okay.